Hello everyone. This week we will cover topic 4, which is the analysis and evaluation of financial statements. Right. The objective of this topic, firstly, is to identify various financial analysis methods. Secondly, is to assess the financial performance of a company from several perspectives or methods. And thirdly, to describe the motivation and impact of earnings management. Now, financial analysis function as an assessment or an evaluation tool, okay, of financial performance and strength of a company, okay, which can serve as a yardstick or benchmark to compare against previous year's performance, as well as to compare with the other companies or competitors within the same sector or industry. And normally the management would prepare them, as well as external parties such as investment analysts, investors, and even students such as yourself. Now, the users can be categorized into internal as well as external users. Um, the internal users, mainly the company themselves, either the employees, management, or the shareholders, as a tool of performance evaluation to compare the performance among the divisions within the company, and can be used for compensation or bonuses, right? As well as a guide for future planning of a company. Uh, for the external users, mainly for creditors, before coming up with, because they want to do credit checking, or even rating, for the company. Suppliers, who want to prepare credit terms, for the companies, and also investors to look at the financial strength and also the growth potential of a particular company. Now, we will start off with the simple and basic analysis, which is horizontal and vertical analysis, followed by the financial ratios. Financial ratios are much more common, commonly used by various users. And for this course, we will cover 5 categories of financial ratios: liquidity, solvency or leverage, asset management or efficiency, sometimes called activity ratios, profitability, the most famous ratios, and finally market value ratios. We will use the same company that we covered before, which is 7-Eleven. We will look at their 2020 financial year-end annual report. Okay. So this is the balance sheet, and this is the income statement of 7-Eleven. Now, for horizontal analysis, normally we can either use a 2-year, comparing current year versus the previous year, or in this case, what I'm showing here is we have the 5-year financial highlights. Okay, you can find the financial highlights of a company in the annual report, normally at the beginning, in the introduction, sometimes contained in the chairman's report, right? Where a selective or selected items, from the income statement, balance sheet, and market indicators, are shown, and in this case, 5-year items. Items are recorded for 5 years, and it is called financial highlights. Now, the main aim of doing horizontal analysis is to look at the changes, how the item changes from year to year, and over the 5-year period, what would be the average. And we will cover both the arithmetic and also the geometric average for this class. Right, so as an example, I've chosen several I've chosen two items. Okay. For example's sake, revenue or sales, and also the net profit. Right. So you can do this in Excel. Right. Copy from Excel sheet that I have worked on. Right. So you jot down the revenue for the 5 years from 2016 until 2020, and you calculate the year-on-year change. Okay. So since there are 5 raw data for revenue or for sales, so you are able to calculate 4 growth data or year-on-year change. Right? Starting from 2017, increased by 3.98%, 2018, 1.37%, 2019, 6.5%, and 2020 recorded the highest change, is 7.54. Okay. So it shows that over the 5-year period, revenue grow every year. Okay. The growth rate vary, right? Lowest being in 2018, highest being in 2020, and on average, okay, so using arithmetic average, so this 4.85% is the arithmetic average. I'm sure all of you know how to calculate the arithmetic average. So you add all 4 and divide by 4. It turns out to be 4.85%. Now, in finance, we are more interested in geometric average compared to arithmetic. The reason being, a geometric average takes into account the compounding. It takes into account time value of money, right? So I think you have done geometric average before. You know how to calculate. There are two methods. First one is simpler, where using the raw data, since there are 5 years, 5 years, so you take the final, the last or the end value of the raw data, which is 2.539 billion here, divided by the first value, which was in 2016, right? And the result of 2.539 billion divided by 2.103 billion, okay, you make it to the power of 1/4. Why 1/4? Because there are 5 raw data. So statistically, you should take n minus 1, which is 5 minus 1, to the power of 1/4. 1/4 is 0.25. And altogether, you minus 1. Okay, so you will get 4.82%. Okay, another method is using the holding period yield, okay, which is, if you look at the 7.454% in 2020, okay, this is the HPR or holding period return. When you plus 1, you will get 1.0754. It becomes holding period yield. You do the same for 2019 here. Okay, so 1 plus 6.5% or 1 plus 0.065 becomes 1.065, 1.0137, and 1.0398. So you have 4 holding period yields. So what you do is you multiply all of them, 1.0754 times 1.065 until the end. And the product of those multiplication, you make it to the power of 1/4. It's the same, 1/4 as well. And you will get 4.82%. It should be the same. So you can practice that using Excel by yourself. If you have any question, then we can discuss in class later. Okay, if you do the same for net profit, okay, you will realize that for net profit, the growth rate is slightly different. Okay, it is basically in general not in tandem with the changes in revenue. Okay, so that is one area of concern to be analyzed later when we do further financial analysis of the company. Notice that although in 2020 revenue increased by 7.54%, but the net profit declined, okay, significantly by 34.63%. So in forensic financial forensic or forensic accounting, you can call it either way. So we would take note on this, and further we would like to investigate further what really happened in 2020. So applying the similar method of calculating the arithmetic average and also the geometric average, so you will get on average over the 5-year period net profit um, decreased by 7.72%, and geometric average declined by 9.29%. Now, for vertical analysis, normally we can do 5 years or 3 or 4 years. Okay, but for this case, I'm using 2 years. Okay, the current year, which is 2020 versus the previous year. And the objective of vertical analysis is to analyze the items that are contained, okay, in the balance sheet. Okay, we would very much interested to look at the items and assess them and calculate them as a percentage of total assets. And we will look at whether or not there are any significant deviation from the previous year. For income statement, we will do as a percentage of sales. So in this case, I'm selecting several items under balance sheet and also income statement. In the textbook, you will see that some textbook, when they do vertical analysis, they calculate the itemized percentage here for all the items in the balance sheet and all the items in the income statement, okay, which is acceptable, right? But although practically we would select the relevant or significant items under each balance sheet and also income statement as shown here, right? So for a balance sheet, okay, we look at the fixed assets. In 2019, it was 71.6% of total assets, whereas in 2020, it increased slightly to 72.2%. For current assets, it's 28.4, declined a little bit to 27.8. Okay, so we assess that there is no significant changes, right? Similarly, for total equity as well. Okay, but if you look at the long-term liabilities, okay, the increase is quite significant, right? From 40.8% of total assets to 47.8. And we look at the raw figure, it was 578 million to 972 million. Okay? So obviously, there were new borrowings, okay, or debts issued by the company over the year, okay, during 2020, which was quite significant, right? Increase. For current liabilities, there's a reduction, right, in proportion. Although the raw figure, the amount increased from 739 to 902, but due to the significant increase in the long-term liabilities, right, it makes the percentage of total assets for current liabilities to decline from 52% to 44.3, showing that over the year from 2019 to 2020, the company rely more, okay, on the long-term capital, okay, in this case long-term financing, okay, as opposed to short-term. Okay, so the comparison between the 2 years based on this vertical analysis. Okay, you do the same for income statement. Okay, we would be interested in starting from the cost of sales. Notice that cost of sales increased quite, I would rather say quite significantly, although net not that high, but from 68.6% to 71.6% of sales, showing that the cost of doing business for 7-Eleven increased, okay, quite substantially over the year. And that is one of the reasons that explains the decline in net profit earlier. So although it's looks small, 3 percentage point, but from a standpoint of company which have a sales or revenue of 2.3 to 2.5 billion ARM, this is huge, right? So controlling your cost of goods sold or cost of doing business is very important for any business, for that matter. In terms of selling and distribution expenses, it declined slightly. As a percentage, looks huge, 27 to 20, decline to 24%. But in terms of the value, from 645 million to 616. So the company managed to save around, I think, about 30 million in expenses. Admin and other expenses, right, increased slightly. There is an increase by about close to 40 million. In terms of finance costs, logically, of course, due to the increase in borrowings, so the interest expense or finance costs increased from 43 million to 54 million. So as a percentage, it's 1.8% increase to 2.1%. So those are the horizontal and vertical analysis. Normally, we do this analysis, these two analysis as a warm-up, and as a general guide into things to come during the financial ratios. Now, going into financial ratios, as mentioned, there are 5 categories of ratios, starting from liquidity, right? And this is important because it measures how liquid is the firm. The question is, will it be able to pay its current commitment bills as they become due? And more importantly is, if let's say somehow you have to pay earlier than when it is actually due. So do you have the capability to pay them? So that is measured by liquidity ratios. Then we go to leverage or long-term solvency ratio. This is basically looking at the capital structure. We are interested to look at the balance sheet and the capital structure to see how much is financed through debt or borrowings as opposed to equity. And thirdly is the asset management or efficiency, sometimes called activity ratios. So there are several items that are used, starting from inventory management, receivable management, etc., to look at the management efficiency in utilizing the assets mainly in order to generate revenue for the company. And profitability ratios is to look at the profitability. There are several benchmarks selected and used. And finally, market value ratios. Some textbooks or modules do not cover this, but to me, this is important, particularly for a public listed company. Market value ratios are important because, as we have seen from number 1 to number 4, all of the other ratios use the accounting data, which are historical. Right? The market value ratios are the only ratios which use the market value or market data, which is current rather than historical, as in accounting data. Starting for liquidity ratios, maybe you have seen this during your undergraduate study. This is the most basic, current assets divided by current liabilities. So for 7-Eleven, in 2020, it stands at 0.63, showing that it is less than 1. When it is exactly 1, it shows that the current assets that the company has during that year exactly equal to the current liabilities, right, which is considered as barely or just sufficient. Whatever bills that you have, liabilities that you owe, can be supported by the current assets that you are having at the moment or during that financial year. But when it is less than 1, it shows that whatever assets, current assets that you are having, okay, is not sufficient to cover the current liabilities, okay, that you have. So in 2019, it was 0.55. So there is, although an improvement, slight improvement, right? 0.55 to 0.63. However, in both years, there are quite substantially less than 1.0. Okay? So this is quite alarming. This is the first signal, okay, first warning signal in terms of current ratio. Right? So if I were the company's management, I would look into measures to improve the liquidity as soon as possible. Next, the more extreme measure of liquidity would be the quick ratio, or sometimes called the acid test ratio, whereby you exclude inventory from the current assets. Okay? So now you only want the most liquid current assets measure. Okay? So you take out inventory because inventory is the least liquid current assets. Right, so you take out inventory. So what is left are cash and bank balances, accounts receivables, right? So you only have the most liquid current assets. So of course, the ratio, in this case, quick ratio would be very much lower. It was 0.31 in 2020 and 0.23 in 2019. So of course, using this more conservative liquidity ratio, of course, it is much lower, right? Another form of assessing the liquidity would be in the form of net working capital. Okay, this is not a ratio, but this is a figure showing the difference between current assets and current liabilities. Of course, earlier in current ratio, you divide current asset divide by current liabilities. Of course, since the figure was less than 1 earlier, so definitely in your net working capital, it is negative. Okay? Ideally, for any company, for any business, okay, for that matter, you want the net working capital to be positive at all times, okay, for your current assets to be greater than your current liabilities. So in this case, it is negative, which is um, in line with or parallel with the quick ratio of less than 1 earlier. Okay. Now going to long-term solvency ratios, okay, we start off with the debt ratio, sometimes called total debt ratio, okay, which is simply total assets divided by total liabilities. Okay. So you look at your assets versus liabilities in total at the moment. So in both years, okay, it's greater than 1, okay, showing that whatever total assets that the company has is greater, although only slightly, okay, than the total liabilities. In general, this is considered as quite normal, okay? But knowing that under the liabilities, there are two categories, right? The long-term liabilities and the current liabilities. So we need to do further analysis, okay, into the capital structure. Now, if you look at the long-term debt ratio, this is what I meant earlier. Okay? When you analyze the long-term debt ratio, this is where the long-term debt is divided by the denominator is long-term debt plus total equity. Okay? Notice that you omit out the short-term liabilities here for the denominator. Okay? It is just the long-term debt plus total equity. So in this case, the ratio is 85.78% in 2020 and 85.03. So it's about 85%. It's showing that the capital structure of 7-Eleven comprise mainly debt, which is around 85%, okay, using long-term debt ratio. Okay. So in this case, the debt holders stake in the company using book value measure, yeah, because the total equity here is based on book value, not the market value just yet. Okay. So in this case, the debt holder stake is greater than that of the equity holders or the share holders. Okay. It depends on companies and industry or sectors. Okay. Certain industries or companies, for that matter, are highly leveraged. Okay. Their long-term debt ratio may be quite high, okay, compared to the others, but on average, if you take into account regular or normal businesses, you do not want your long-term debt portion to be significantly higher than the equity, even at the book value stage. Okay. Long-term solvency, this is debt equity ratio. Okay. The equity ratio is total debt divided by total equity. Okay. This is another benchmark to compare with debt and equity, but now we take the total rather than the long term. Okay. So in terms of total debt as opposed to equity, the multiple is 11.63 times in 2020 and 12.93 times in 2019. Okay. So basically the ratio shows how many times the total liabilities is greater or lower than the total equity. So in this case, it is about 11, 12 times more than equity. So as I have mentioned, you do not want this ratio to be high multiple. Okay? This is concerning its financial sustainability as well as the propensity or probability to face financial distress later, okay, when your capital is highly leveraged. Right? Another measure is called times interest earn ratio. Another name for it is the interest coverage ratio. Basically, to look at the operating performance in the form of operating income or EBIT. EBIT is earnings before interest and taxes. And how many times over can the operating income cover the interest expense for that particular year? Okay, so for 2020, the interest expense is about 54 million, while the operating income or operating profit, okay, or EBIT is 170 million. So it's about 2.17 times in 2020 and 2.76 times in 2019. Okay, so as far as the operating income is concerned, the company has relatively sufficient, okay, amount to pay its fixed obligations, okay, because interest expense is fixed. Of course, the bankers are interested in this type of ratio. Now we go to the asset management or efficiency ratio. There are 6 categories altogether. We start with the inventory and then receivable. Then we look at true turnover ratio, which is total asset and fixed asset turnover. For inventory, we are interested in looking at how efficient is the company utilizing or processing its inventory, okay, before converting it into finished goods and finally sell it off. Okay. So in order for you to do that, okay, we need to calculate inventory turnover first, okay, which is cost of goods sold divided by the inventory. Now, inventory here, the best would be for you to calculate the average. Okay. So since we have the figure for 2020 and 2019, right? So for inventory turnover, okay, we are able to calculate only for 2020, whereby the average inventory here is calculated as the inventory in 2020 plus the inventory in 2019. Okay, altogether, divide by 2 to get the average. And for the cost of goods sold, okay, this is the cost of goods sold for the year 2020. So the inventory turnover ratio for 2020 is 6.99, about 7 times. Okay. And this shows that inventories are turned over about 7 times. Okay. So on average, you make an order for inventory for 7 times during the year. on average. Okay? And what does this entail? What does this imply? If you divide this with from 365, you will get what we call the days sales in inventory. So this 7 times inventory turnover implies that the inventory period is 52.22 days. Right. So if this is a manufacturing company, it shows that on average, inventories, the raw materials sit in the warehouse or in work in progress, as in the case of 7-Eleven, before they send it to the stores to be sold for about 52 days, okay, before they're being sold or sent to the store. Again, you have to compare this with the practice of your competitors, okay? And you have to look also at the credit terms given by the suppliers, okay? So two things there, okay? You need to compare vis-a-vis the credit terms as well with the terms by your suppliers, okay? As well as the practice. Okay? How do you fare against your competitors? What is the norm, common practice in the industry? Okay, to see whether you lag behind or you are ahead in that sense. So if there is a deviation, okay, so you need to sort out, okay, and improvise. Okay. For accounts receivable, okay, it's quite similar, whereby you need to find the average account receivable for both years. But in this case, you use sales. And the sales figure that you use here, where you divide by the average accounts receivable, by right or technically, it should be credit sales. Okay, so you omit the cash sales. Okay? But of course, for the sake of example, let's assume that whatever revenue or sales figure that you see in the annual report, okay, or your assignments, okay, and even for 7-Eleven here, let's assume the whole revenue or sales there as credit sales. So we can use the whole figure. But if, let's say, in real life, okay, in practice, you have the information with regards to the percentage of credit sales, then you should multiply with the proportion of credit sales first, and before dividing it with the average accounts receivable. So in this case, the account receivable turnover turns out to be 29.51 times. Okay, so receivables are turned over about 29.5 times during the year. And this is equivalent to 12.37 days of average collection period. Okay? Showing that it takes the company an average of 12.37 days to collect the receivables from their customer. Again, although it looks good, but of course you have to check with the credit policy that you have with your customers, right? Maybe you need to revamp it, change it, okay? And also the practice in the industry, okay? With regards to the type of business that you are having. Okay. Next one would be the total asset turnover. We want to compare the sales against the total assets. As much as possible, we want the sales to be higher than total assets. Okay, so in this case, it is higher. Okay, sales or revenue is 1.25 times and 1.66 times greater. Okay, but in for certain companies, especially those in capital intensive industry, such as airline, for example, or automotive industry, it is normal to see total asset turnover to be less than 1. Okay, so in those companies, the total assets are much greater than sales generated annually. Okay, so it is not uncommon, okay, to see that, but only in capital intensive industry. But in other regular retail-based manufacturing and whatnot, and manufacturing also depends if it is highly intensive also. Okay, but other than that, if it is not that highly intensive in terms of capital, we would expect the total asset turnover to be greater than 1. The next would be fixed asset turnover. which is sales divided by net uh, fixed asset. Okay, your fixed asset. Of course, you also want the sales to be greater, but this is where we want to compare the intensity, okay, of your fixed asset. Okay, this is where we compare with your competitor, okay, with the other companies in the industry or in the sector, okay, to see whether you are firstly capital intensive or not, or secondly, how efficient are you in utilizing your fixed assets in generating the revenue as compared with the other competitors. Okay, that is how you use these ratios. Right. Number four, the fourth category is the profitability ratios. Okay, this is the most famous. Normally, when people talk about financial ratios, they straight away jump to the profitability ratios. Right. Whereas in reality, as you have seen, there are other categories which are important as well, not just profitability. Right. So for profitability ratios, we start with the gross profit margin, which is the gross profit divided by sales. Okay, this is the first layer. This is the profit that measure the business as a business. So if you're a business of selling chocolates, for example, this measures how good are you in managing your raw materials, the cost of doing business, which is cost of sales, right? In generating the revenue. Okay? So analysts would normally focus on this. Of course, later on we look at profit before tax and eventually net profit, but those figures comes after various things, depreciation, taxes, okay, and whatnot, interest, okay, the financing and investing aspect. But for, as far as the business aspect is concerned, this is an important measure. Okay, we would focus on this. We would look at is the cost managed well? Was there an increase or decrease? What is the reason of increase or decrease and whatnot? Okay, so in this case, we interpret it as for every $1 in sales, the company spends about 70 cents on raw materials and goods. Again, you have to first compare with your previous performance. And secondly, you have to assess carefully with regards to the practice in the market, whether or not this is acceptable. Is this considered as a good cost management? Okay, are you doing a proper costing, okay, on your raw materials, okay, etc. Okay. The next layer would be the operating profit. Okay, this is earnings before interest and taxes. Okay. And in this case, about 4.64% and 5.1% in 2019. Okay, decline, but it is only around 5 cents. Okay, so from the standpoint of operating profit, okay, this is before taking into account interest and taxes yet. Yeah? So for every $1 operating profit, okay, from your operations, okay, which include cost of goods sold, expenses, depreciation and whatnot, is only around 5 cents, which is only around 5 cents, which looks small. Yeah, we can say it is small, okay, but 7-Eleven playing with volume. Okay, they have many stores, okay, around the country. So most notably, they play with the volume. Okay, and this is an industry or a sector business with low profit margin. Okay. Finally, at net profit level, okay, you see that it is very much lower. Okay, 1.39% in 2020 and 2.29% in 2019. Right, and again, similarly, the way we interpret it is for every $1 sale, okay, the net profit, okay, is around 1.4 to 2.3 cents. Okay, so very low profitability. Sometimes, if we look at it from this standpoint, okay, we may question, ourselves if we were the 7-Eleven management. whether we still want to be in the business or not. But of course, you have to compare with the other competitors, and also you have to make segmental analysis, okay, in order to identify the profitable segments within the group. Okay, so we will discuss this further in class, okay, with regards to the segmental analysis of 7-Eleven. Okay, the other two famous, in fact, I think you have seen and heard ROA or ROE much more than other ratios. Okay? Sometimes you hear, most of the time you hear ROI. Okay? When you watch films, or when you listen to people talk, or you read newspaper, people talk about ROA, ROI. Okay? But in fact, these two are actually only two out of the many ratios that we should focus on. ROA, or return on assets, is net profit divided by total assets. From finance perspective, we can also call this ROI, which is return on investment. And that investment refers to capital investment. Sometimes financiers, they further divide the total assets into just the long term, okay, or the capital, the fixed assets only, to refer to the investment, and investments there refer to the capital investment. In this case, we take the total assets. So ROA is about 1.74% in 2020 and 3.8% in 2019. Okay, this is measuring how good is the company's management, okay, utilizing the assets in generating the revenue, in generating the net profit. For return on equity, it is net profit divided by total equity. Remember earlier I said that the proportion of the equity is much smaller compared to liabilities, right? In fact, in our long-term debt ratio earlier, the ratio was about 85%, leaving equity only about 15%. Now, due to the small magnitude, the small proportion of equity with respect to or compared to debt, the return on equity, as shown here, is high, because you divide with a small number. The same net profit, for both years, you divide with a much smaller figure for equity here compared to assets. So that's why your ROE is 21.93% in 2020 and 52.97% in 2019. Okay, it is quite high, although there is a sharp decline, okay, from 2019 to 2020, of course, because of the decline in net profit we've seen earlier, okay, and also an increase in total equity. So both the numerator declines, okay, and denominator, numerator declines, okay. So even though the denominator increases, okay, the result would still be the sharp decline in the ROE. Right. The last category would be the market value ratio. Okay. Now, this is something that the analysts would be interested in as a starting platform, okay, as the preliminary analysis, okay, of the company. And in order for you to do that, okay, your interest would be to calculate the price earnings ratio. But before calculating this price earnings ratio, you need to calculate the earnings per share first. Notice that in the annual report, in the income statement, down at the bottom, the annual report showed the earnings per share already calculated for you. And in the notes also, they explain how they calculate the earnings per share. In this case, earnings per share is the net profit, okay, attributable to the shareholders. Okay, this is not the net profit that we use for ROA and ROE, the total. Okay, we deduct, as I mentioned, the share on the portion on the minority interest. So for 7-Eleven, there is a difference between the two figures. Okay. In 2020, the net profit attributable to shareholders was 29.766 million. And you divide it with the number of shares. The number of shares here is what we call the weighted average capital, or WAC. Not to be confused with WACC later. Okay. This is WAC, or weighted average capital. Okay, I will explain in class what is this and how to calculate the weighted average capital. Okay. And it turns out to be 2.6 cents in 2020 and 4.74 cents in 2019. Based on this EPS, or earnings per share, we then calculate the price earnings ratio, okay, which is basically the price per share for the stock, for 7-Eleven stock, divided by earnings per share. The question is, what price should we use? Okay, so are we using a 7-Eleven price in 2020 to divide with the earnings per share in 2020, and then later find the price for 7-Eleven in 2019 and divide it with the EPS in 2019? Okay. No, right? The answer would be, we go and find the latest price as of today, current price. Even though currently we are in end of May 2023, but we are doing the analysis for 2020 and 2019. What we do is we find what is the latest price for 7-Eleven. Okay? And when we check, the latest price is 2.04 ringgit. So we use that 2.04 ringgit for both years. For PE, or price earnings ratio, in 2020, 2.04 divided by earnings per share of 0.026. Okay. Remember, when you calculate earnings per share earlier, this 2.6 is in cents. Okay. So cents, if we were to write it in dollar, because we want to divide it from 2.04 ringgit, okay, so in ringgit terms, it is 0.026 ringgit. Okay. So many students make these mistakes, and they simply divide with 2.6, which is wrong. Okay, so 2.04 ringgit divided by 0.026 ringgit turns out to be 78.46 times. And in 2019, it is 43.40 times. Okay. We interpret it as the company is trading at 78.46 times its 2020 earnings per share, and 43.4 times its 2019 earnings per share. Meaning, currently at the price of $2.04, 7-Eleven is trading at that multiple, 78.4 times. Okay, multiple is 2020 earnings per share, and 43 times is 2019 earnings per share. So what it means is that the company's earnings per share, which is their profit, okay, their earnings capability, okay, their profit strength, is only 2.6 cents and 4.74 cents. But investors are paying $2, okay, 2 ringgit, okay, which is 78 times its earnings potential per share. So if we learn investments, okay, there are explanations, okay, in terms of market behavior, market psychology, right? Investors' risk tolerance, and many things. Okay? But as of now, what we are saying is that it can be considered relatively expensive. Expensive in the sense that it is in a high multiple of its earnings per share, way higher than its actual earnings per share. Okay? Of course, you need to check again with the trading range in the sector, and more importantly, the growth prospects. Sometimes investors are willing to pay high today because of a potential, because of the growth prospects of the company. Of course, we're not going to cover that in corporate finance. That will be covered in investment courses in terms of the growth potential, meaning we tag the growth potential with the price earnings ratio. Okay? Okay, and finally, another market value ratio, which normally used as well is the dividend yield, okay, which is the dividend per share divided by price per share, stock price per share. Okay? And to do that, you need to calculate the dividend per share first. The 26.545454 is the amount of dividend paid by the company. Okay, and when you divide with the number of shares, it turns out to be 0.0231 ringgit or 2.31 cents. Okay, and 2.37 cents in 2019. Okay, and excuse me. So the dividend yield is using this dividend per share, you divide with the stock price per share earlier. So you will get 1.13% in 2020 and 1.16% in 2019. Since the denominator is in the stock price, right, and the numerator is the dividend per share, how much the each shareholder gets in the form of dividend for every share that they purchase. And you divide it with how much did the investor spend when they buy the share, okay, in today's market price. Okay? So if you look at it, is not that attractive. It shows that for every $1 that the investor spent to buy the share, they only receive dividend in the amount of 1.13 cents, okay, and 1.16 cents. Of course, if they put their money in, say, even less risky investment, FD, unit trust, ASB, and whatnot, you will get higher. Okay? You can get much higher yield, okay, comparatively compared to investing in 7-Eleven. But of course, that looks only at the dividend yield. For stocks, there is another component called the potential capital gain. So maybe if you include in or attach it with it the potential capital gain, it will be much higher. But of course, that is subject to another analysis and further analysis, okay, mainly using the fundamental analysis, which we are not going to cover. Okay, so your coverage should be up until the calculation of dividend yield here and how to interpret, okay, whatever dividend yield measures that you calculate. Now, after you have calculated all the ratios, okay, we will have to do an overall analysis, like the so what. Okay, at the end, so after looking at all 5 dimensions from liquidity up until the market value, so what would be our conclusion? What would be our assessment? Okay, so since this is just looking at the financial strength by way of financial analysis, mainly financial ratios, there would be no recommendation as far as the market value of or the stock price of the company is concerned. Okay, so if we are not going to recommend buy or sell and whatnot, okay, we are going to assess, make a conclusion. Our recommendation mainly more in the line of suggesting certain measures need to be taken. That's all. Exactly what measures, that is up to the management. We stop short there. Okay, so for the sake of simplicity for the cost. Okay? If not, then we will take a longer time to complete the cost. Okay, starting from liquidity, it is in red. Why red? Because all 3 measures show that the company is not liquid. Okay, so that's why we recommend that the company needs to immediately take some mitigation measures, okay, to with regards to its liquidity issue. In terms of solvency, we see that in general, okay, the proportion of long-term debt is high, okay, meaning that it is highly leveraged. Okay, we say that it should be cautious. We don't say that debt is not good. Okay, of course, if used properly and optimally, that has its advantage, mainly in terms of tax reduction, right? And also as a leverage, rather than using the equity money of the shareholder, we use that other people's money, okay, to increase the return. But it should be done cautiously. Okay? So again, company has to assess this and ensure that it will not face financial difficulty. Okay, let's say financial distress or even bankruptcy later. Thirdly, efficiency. This is the only green area. Okay, what we can conclude here is that the good inventory management and accounts receivable, okay, management. This is part and parcel of working capital management, okay, which is quite good. And the company is relatively efficient in utilizing its assets to generate sales. Profitability, I don't put red, put yellow. Why? Because although in general the profitability is low, okay, and this calls for cost containment or management in order to improve. Okay, but in terms of ROE, it is quite high. But the reason it is high is because of the relatively small portion, okay, or amount of equity relative to that in that company. And finally, for market values, right, we say that the stock is expensive because it is trading, although it is only 2 ringgit, but that 2 ringgit is 78 times multiple its earnings per share. So to us, it is trading at high multiples and considered as expensive. Okay? The dividend yield is not attractive, okay, and is considered low compared to other low risk investments. So those are the overall analysis that we can make for this company after calculating all the relevant ratios. Okay. Okay, the next section, okay, which is this is you can read this on your own. Okay, some issues, okay, on earnings management. What are the among the actions, okay, that a company can take, okay, um, to manage its earnings? Or another word is to manipulate, okay, its earnings. In the introduction, we discussed a little bit about when we discussed why net profit, okay, should not be the main goal, and we discussed a little bit about the potential earnings manipulation, okay, or management. So in this case, it expands and look at from various angles, many possibilities. Yes, examples are given, okay, in the module. It mainly here focus on the revenue. Okay, you record too soon. Okay, it is not should not be declared just yet. Has not happened, but you already have recorded as revenue, and even worse, bogus, which is false. Okay, and certain one-time, okay, or extraordinary items, activities, but you you include it and put it as your income, and it boosts your income, okay, which can be misleading, particularly to potential investors in that regard. Okay, and there are a few other examples as well. It can, with regards to cash management as well, in terms of the financing item, okay, you shift it to operating item, right, and etc. Okay, so you can look at the examples yourself. Okay, okay, that's all. So I see all of you in class. Right.